Welcome to CPA Australia's webinar, COVID-19 Challenges for Auditors for 30 June Year Ends. My name is Siobhan and I will be hosting this webinar and available for any troubleshooting questions you may have with your WebEx setup. Some of you may have attended our webinar on Tuesday, Considerations for Financial Reporting for 30 June Year Ends. We would like to again apologise for the technical issues experienced during that webinar and reassure you that we will be re-recording the event and circulating that recording in the next 10 days. Should we experience any technical difficulties in this session, we will message you in the chat box and you will be contacted via email following the webinar. We have people joining us from all over the country for today's webinar. I would like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. I would now like to introduce you to today's chair, Claire Grayson, who will facilitate the session. I'll open your mic now. Hi, Claire.
Thank you, Siobhan, and welcome everybody to this CPA Australia webinar. I'm Claire Grayston, CPA Australia's Policy Advisor for Audit and Assurance, and I'm delighted to be facilitating this session today with three very knowledgeable speakers on the COVID-19 challenges for auditors this reporting season. All of our speakers have been focusing the vast majority of their time over the past 4 months or more on COVID-19 reporting and auditing issues for entities and their auditors. So they have a lot to share with you today. During the webinar, we'll have 3 presentations, followed by a panel discussion, which we will include your questions, which you can put in the Q&A box as we go through the presentation. We'll hear from Doug Niven, the Senior Executive Leader, Financial Reporting and Audit at ASIC. Doug will spend about 25 minutes on ASIC's perspective, covering ASIC's frequently asked questions that they have posted on COVID-19 challenges. And Doug will also touch on ASIC's key focus areas for 30 June 2020 as a result of the changes we're experiencing from COVID-19. Anne Waters will then speak. Anne's a Senior Project Manager at the AUASB. Again, she'll speak for about 25 minutes on the AUASB's perspective, their joint guidance that they've issued with the AASB, as well as the lengthy FAQs that they have published. And then finally, we'll have Liz Joost from Qualitas Consultants. She'll speak just for 10 minutes to allow a little bit more time for our panel discussion, and she'll talk about the practitioners' concerns and the practical issues that auditors are struggling with currently. We'll then, all of our speakers will then participate in a panel discussion, which I'll facilitate, and we'll have about 25 minutes left for that, and we'll incorporate your questions into that discussion. So do please feed in those questions to the Q&A as we go through the presentations, and we'll look at all of those at the end during that panel discussion. Jana Schmitz, our Policy Research Analyst here at CPA Australia, is also on the line, and she will be assisting me in monitoring your questions and feeding those in to the panel. So just briefly, before we get started on our presentations, for those of you that aren't familiar with our speakers, Doug Niven is, as I said, the Senior Executive Leader, Financial Reporting and Audit at ASIC, and his team is responsible for the regulation of financial reports and audit. This includes ASIC's financial reporting surveillances and audit firm inspection program, financial reporting and audit policy, auditor surveillance, and advising other ASIC teams on these matters. He also is involved with the SMSF audited deregistrations and suspensions and digital financial reporting. He's a member of IOSCO Committee 1 and the International Forum of Independent Audit Regulators. Doug's been with ASIC for 22 years and previously with a large audit firm for 15 years. We'll then hear from Anne, and Anne's a Senior Project Manager at the AUASB, where her primary area of focus is financial statement audit. She has been leading the AUASB's audit quality initiatives and has been closely involved with issuing the guidance for auditors to assist them in fulfilling their responsibilities during this time of COVID-19 pandemic. Anne's also been working with the Financial Reporting Council on areas related to audit quality, and she was previously a Senior Manager at KPMG. Liz just runs her own consulting firm, Qualitas, and assists her clients with training, quality, expert witness and technical matters. Liz is chairing the large national networks discussion group, and so I know firsthand that she's been keeping her finger on the pulse in relation to challenges faced by auditors during COVID-19. Liz has over 30 years experience, including with the Big Four and as well as in the mid-tier space. So I'll hand straight over to Doug Niven from ASIC, who's our first speaker. Thank you, Doug.
Thank you very much, Claire, and quite a lot to cover today, so I'll try and go through it fairly quickly. In this presentation, we'll be talking about the audit side. On Tuesday, for those who were at the session, we did talk about financial reporting aspects. I'll cover some of that initially, but obviously not repeat it all. Of course, the focus here today is the audit side, but there are going to be some real challenges for both the auditors and, of course, preparers and directors as well. Claire mentioned the practical issues. I'll touch on some. Liz will cover that perhaps in more detail. But in the current environment, of course, there are a whole range of uncertainties, and that will create challenges in the audit process as well. Some difficult judgments for auditors around audit evidence, accounting policies, accounting treatments, and disclosures. So we'll talk about that. But the objective, of course, continues to be confident, informed markets and investors. And that's going to be even more important in the current environment, given these uncertainties and the impacts on entities, that users are properly informed about what's happening with the entities, and so disclosure is going to be very important. There's been a lot of discussion recently in various fora here and internationally about the value of the audit process, and this is the opportunity to demonstrate the value of the independent audit in these challenging times. And so from a financial reporting point of view, we put out a media release earlier this week, which confirms the focus areas we put up on our website and frequently asked questions. At a higher level, we're asking directors, preparers, and also auditors to focus on asset values. Clearly, they can be impacted by a range of factors. I'll come to those factors in a moment. Provisions for things like onerous contracts, guarantees given, perhaps even restructuring of the business. Yes, in some cases, there'll be questions around solvency and going concern. And we also need to focus on how things are evolving in a subsequent period, with what's happening in the months up to signing the financial report. Could lead to some new circumstances, perhaps a narrowing of assumptions, but we'll find out. And as I mentioned, disclosure in both the financial report and in the operating financial review for listed companies or the review of operation for unlisted companies is going to be so important to telling the whole story and complementing the information of financial report. What are the underlying drivers of business? What are the management strategies going forward and the future prospects? So I won't go through the next slide in detail, but this is a non-exhaustive list. It's available in our FAQs on our website and also the media release of some of the factors that need to be considered by companies and how their business is going to be affected, but also assets, liabilities, going concern assessments, potentially, and of course, solvency. So what's happening with the economy going forward, both here and internationally, the industry they're in, both the supply side and the demand side, and remembering also that there are entities that have a range of impacts that influencing the business prior to coming into the current circumstances as well. And there will be some questions about what's happening to a business in the shorter term, particularly if there could be short-term impacts, restrictions, liquidity issues, but the business is fundamentally sound going forward. But you can see there's a whole range of things that are uncertain. I guess we all would have thought a couple of weeks ago we wouldn't be seeing more lockdowns. Of course, we're all hoping that that will be sorted out very soon. There are also questions about government support, and you will have seen the announcement last night by the Prime Minister that I think it was on the 23rd of July. They'll tell us more about what's happening with government support measures going forward. Obviously, how an entity is funded continued funding, ability to raise capital. A number of companies have already done that, will be so important as well. But given those uncertainties, and I should say, by the way, those are uncertainties to think about on the impact of Nearly itself, but also all the same factors you need to think about in terms of all of those important parties that interact with the company, those borrowers, suppliers, etc. But these uncertainties mean that it's going to be so important to come up with reasonable and realistic assumptions, knowing though that there potentially could be a broader range of reasonable assumptions and, for example, asset values, given those uncertainties. Now, some of that can be dealt with through probability weighted scenarios, but in the end, yes, there'll be a narrowing of assumptions and perhaps more information as we go on, but there will be difficult judgments, and that means disclosure around those assumptions are going to be so important. For example, two companies in the same industry may have made different assumptions, and users of financial reports in understanding their position, their performance, will need to understand those differences, potentially overlaying their own assumptions as well. So from an audit point of view, and thinking about the first part of the audit process, the planning and risk assessment, that's, as we all know, vital to a successful audit, and things have changed. So understanding the business is a key to all of this. What are the things that are going to impact on this particular business? Whether it's a JobKeeper, travel restrictions, whatever it might be out of that list we talked about before, and other factors as well. And reassessing those as it goes on. There are some specific things. Increased risk may mean you've got low materiality and therefore potentially more audit work to perform. Yes, there's going to be difficult judgments we talked about, and that means we need to ensure you've got appropriate experience and expertise applied. It's a case that, yes, auditors may have people who've been through the global financial crisis and some of the difficult issues there. This is a different set of circumstances again. And so we do think that it will be important that partners do actually devote more time to all parts of the audit process here, sharing their knowledge, experience and judgment as well. Some of the practical issues we'll touch on later, I'm sure Liz will as well, around remote access. I must admit, I was thinking that might start to subside, but obviously, some new issues arising there. All of this feeds into the nature, timing, extent of audit work. If you can't, for example, rely on controls, they've changed with remote access, remote work, then you may need to do more substantive testing. But overall, working with the audited entity, planning things out is the best way to deal with pressures, making sure there's enough time for directors and the auditors to do their job and make the judgments that they need to make and not be rushed and therefore potentially missing something or coming up with inappropriate or not the best judgments. Professional skepticism is always important in audit, as we know. An audit isn't just about finding ways to rationalise or support what has been put into the financial report. It's also about challenging some of the difficult judgments and the assumptions. We recognise the greater uncertainties as well, but we want people to be coming up with realistic and supportable assumptions. They shouldn't be overly pessimistic or overly optimistic. So in current circumstances, when you're looking at impairment of non-financial assets, yes, you have to impairment test goodwill and certain longer life intangibles, but where you've got assets that only need to be tested with impairment triggers, a lot of those factors we talked about before will lead you to a conclusion you've got those triggers and need to do the full-blown impairment testing. Obviously, think about inconsistencies in the information presented and overall cross checks against other methods and standing back. Accounting treatments are another area of difficult judgment, and I just listed, we won't go into detail on these, but there are obviously some complex accounting issues on things like loan deferrals and restructuring. We've covered a bit about expected credit losses, which applies, by the way, for trade receivables as well in our FAQs. A lot of the history and models that you used before you can't use anymore. Rent concessions, we've got an FAQ which covers the accounting by lessors. We're having further discussions around lessee accounting. you've also got some questions about the right of use asset. That's actually not necessarily a COVID one, but how you treat that and how you do impairment calculations, and of course accounting for government assistance and support. And by the way, disclosure, that's really important as well to users. And judgments on audit evidence I'll come to in a moment, and those different disclosure questions. Now, on the audit evidence side, when we're talking about things like expected credit losses and rent concessions, you're dealing with other parties, their capacity, and so you need good data. And perhaps the data you had before doesn't work anymore, maybe it's outdated. And so we know there are companies that are actually in the process of trying to get better data from counterparties. Of course, the assumptions and factors are being used. You need to do more work on those. I'll try and go fairly quickly here because we've got a bit to cover in a short space of time. Effective operation of controls, where they may have broken down with remote work, what that means, or they've been replaced, and how you verify those, perhaps even remotely in some cases. Some of the analytical procedures and relationships that people were using, whether substantive or non-substantive, maybe they don't work anymore. Particularly non-substantive procedures where perhaps people would try and compare with ratios from prior years. Use of experts, always some issues there, but experts may not be able to do evaluations attending premises in some cases, looking at buildings. Other auditors, you need to think about all those component audit issues and are you able to get access to what you need to in terms of their work? Are they able to access what they need to, in particular if it's in another country that's in lockdown? And ultimately, there may be circumstances where there are limitations on scope. Sometimes you need to bite the bullet. You can't keep waiting forever for further information, and it needs to be reporting to market, and that may be a potential outcome. Now, I mentioned disclosure is so important. Think about what you need to disclose, or what the company needs to disclose, by putting yourself in the feet of the investor or user of the financial report. That's the best way. And so it's about telling the story, but also having sufficient detail on the assumptions and so forth. So financial reporting, as I mentioned before, source of estimation uncertainty is a disclosure requirement. Be specific, though, in what you're disclosing to the entity. The key assumptions, again, sensitivity analysis, but we're saying, actually, you may need to do not just for loan loss provisioning or receivables, but for other things like value in use and fair value, probability-weighted scenarios, the current scenario or current situation. Government support, as I mentioned, disclosing the amount, timing, and so forth, which is important to users. They need to know how much the financial results have actually been affected by government support or support by others, for that matter. Land tax is part of it, but also some of the debt things that we heard about last night as well. Solvency statement. The audit covers the solvency statement. So the auditor does need, and Noanne will talk about this more in her presentation, but the auditor does need to form a view in relation to the ability of the company to pay its debts as and when they fall due. In our view, that will be a material disclosure, particularly in the current circumstances. The interesting point is that because of certain relief that's been given, potentially there will be companies that are trading while insolvent, which you wouldn't have seen in previous circumstances, even though the business may be fundamentally sound and it's a going concern. That's an unusual situation. Solvency is about the ability to pay debts as and when they fall due, and we'll cover this further, but going concern is about significant curtailing business going out 12 months from balance date or longer. Okay, operating a financial review. Okay, not strictly part of the audit opinion, but as we know, there's an auditing standard which says about reading that, material inconsistencies, misstatements, and so forth. And you see the third bullet point there. Good reminder that if there is a problem that you become aware of in the operating and financial review, that could be a contravention of the Corporations Act, which the auditor does actually need to report to ASIC under Section 311. So just a sleeper to think about. But the operating financial review is going to be so important because it completes the picture, tells you the story, the underlying drivers of business, the risk, management strategies, and future prospects. So the other thing, I won't go into detail, have a look at our FAQs, but think about the presentation, appropriate presentation, non-IFRS financial information. We give some scenarios there that can be problematic, like people trying to come up with hypothetical profits if COVID-19 hadn't occurred. Well, we think that's inappropriate. And I'll keep going. So, of course, reporting by the auditor is important. We said from the outset, a blanket approach is not going to be very helpful. It needs to be specific. You need to think about circumstances company by company. Some will be fine because they're actually positively affected by the current circumstances. There may still be some uncertainties, but in other cases where companies are adversely affected, you need to think about the specific circumstances of the company and the value of the audit opinion. Yes, we probably will see more modified opinions and so on. In terms of reporting suspected contraventions, a couple of specific things. Have a look at our FAQs. We do cover this. Because of some relief from liability for insolvent trading, there might be some circumstances, and that's only about director personal liability, where companies are trading or insolvent. The intention was to allow good companies fundamentally sound with short-term liquidity problems to trade through, but it's still a contravention that needs to be reported, an important one, insolvent trading. Whereas in case of AGMs, we've given no action position for an extra 2 months to hold an AGM, and we think that wouldn't be something that needs to be reported. Okay, some of the other focuses. We do think, and it's dealing with hindsight. Because of the difficulties here, it's going to be important that the auditor, as well as the company, documents exactly what the circumstances were when they're making the judgments around all of the things that we've been talking about, because others will come in afterwards, potentially looking at that, and it's a good reminder about exactly where you were, what you knew at the time, and why you made the judgments that you did. Obviously, supervision review is important for auditors in all circumstances, increasingly so in the current environment. And I'll perhaps skip over a couple of perhaps we talked on before. Generally, in terms of audit quality, the process around analysing internal and external findings from quality reviews and inspections is also important. Action plans to address those longer term as well. And, sorry. Okay. Now, I think Liz will probably cover some of these practical issues later on, so I won't go into a lot of detail, but just to reiterate, the whole process of reporting in the audit is going to be affected by those difficult judgments we were talking about before, but potentially also inefficiencies where there are remote work arrangements or controls weren't operating properly. So planning about all of that's going to be so important. It's also about thinking about better ways to work. And in the case of the auditor, yes, it's about the judgment areas experience. How can you access information? So people probably work this out largely now, the electronic and technology means. There have been some legal issues about sharing information across borders. Perhaps I'll just leave it at that. We don't have time. This is a question on that. We can cover that further. I'm sure Liz will talk about the people side. And also, if we have more time, we could talk about how you can conduct virtual stock takes and system walkthroughs. But certainly there's some real issues for auditors to think through and plan ahead on all of these sorts of practical issues. And overseas components, if there are further lockdowns, that can cause some issues as well, even getting component auditors into operations and what that means. We already saw some of that at reporting around December and March as well. And finally, leading on from those practical issues, of course, what we have done is, and we did this in a couple of slices, but we have now given all listed companies, unlisted companies, Australian financial services licensees, managed investment schemes, additional time to prepare and lodge their financial reports. And this runs up to the 7th of July, that's 30 June, plus or minus 7 days. That allows for the retails and so forth who might move their balance dates by plus or minus 7 days. But it's important to remember while giving that extra month, and we got a lot of feedback that that was a reasonable period. There's different periods in other jurisdictions. And yes, by the way, it is possible to apply for additional time. We expect that companies will only use that as a backstop. It's really only where it's necessary because it comes back to the importance of the information in the market on a timely basis. And to illustrate that point, we did a lot of analysis throughout the whole company population based on historical information. I'll just quote one example. Listed companies have 3 months to prepare and lodge a financial report. The top 100 companies on average last year did that in 62 days. So there was already room to move in the system anyway. But at that end of the market, it can also be about confidence in the reporting process and so forth, as well as the needs of users to report on a timely basis. Now, just to mention, while we've given this additional time, it does flow through to the ASX listing rules, it doesn't apply to preliminary finals. So preliminary finals do need to be provided to ASX within the normal 60 days. They don't have to be audited, although particularly larger end, most companies had audit work substantially completed in the past before that time. And of course, there's also half-year requirements from ASX which haven't been changed. I mentioned before already the no action position for AGMs. It's also worth mentioning because it does affect the auditors as well. There is a provision for the Treasurer to modify the Corporations Act in window of 6 months and lasting for 6 months. So it is possible to hold virtual meetings where appropriate participation possible. That runs out on the 2nd November. It may well be a matter for Treasury and Government to think about what happens after that. In the meantime, of course, that does raise issues for auditors around their participation and being asked questions as well. So you need to think that through in the case of public companies and AGMs. And again, this is perhaps a little bit predating the current circumstances, but I'll just remind everyone that there's still more work to be done overall to improve audit quality. Our last inspection report covering the 30 June, 12 months, 30 June last year, 19, which was issued in December, questions about statistical questions on small populations of files and so forth. But it was showing 26% of key audit areas we looked at on a risk basis. We didn't feel the auditor had obtained reasonable assurance that the financial report was free of material misstatement, and won't go through the percentages for different tiers, large, mid and small firms, with the findings across all of those. And to emphasise that they were in areas that we've just been talking about, asset values and the like. So you really need to think about that. Action plans for firms to improve audit quality, we think, are really important, but we've also announced we've got across all areas following the Financial Services Royal Commission, a strong focus on enforcement. We always think about why not litigate. That doesn't mean litigate always, but that's an important limb of what we're doing. The greater transparency of inspection results for particular larger firms through our reporting process. We've also been looking at some quality control areas around culture, talent, governance, conflicts and accountability for larger firms, and we'll be reporting on that, by the way, for 30 June 20, with the exception of some areas that because of COVID-19 we decided not to complete in the areas of culture and talent. That will be done in the first half of 2021. Importance of root cause analysis we've already touched on. We were going to consult publicly about routine reporting of our findings to audit committees. That's been deferred, just to let you know. And last year, for the first time, we did put out a broader group of audit quality measures and indicators at the same time as our inspection findings. I won't go into perhaps detail on that now, but you may want to look at report 649, which is on the website. So covered a lot in a short space of time, but just to let you know, there are various information sources. I'm sure Anne will talk about the AUSBs, FAQs in a moment. We do have media releases on our website that cover those reporting deadline issues. Earlier this week, we did issue that media release on our focus areas, and it goes into quite a lot of detail in asset valuation areas and the like. Various regulatory guides on, shouldn't give you all the numbers there, but they're to do with solvency, non-interest financial information, operating financial review, but information sheets on impairment, directors' duties, and of course those inspector reports I talked about. So just to sum up before I hand over to Anne in a moment, so important for companies and auditors. Yes, there are challenges in the current environment. We recognise that, but you need to think about users' needs in the end, applying the appropriate expertise and experience, thinking about the difficult judgments, which include the importance of disclosure, and disclosures can be material, and so do need the attention of the auditor. So perhaps I should stop there in the interest of time. I think I'm right on time there. So, and hand over to Anne, who will obviously talk further about things from the AUSB's perspective.
Thank you, Doug. Let's go on to my slide. Right on time too. Perfect. Hi everyone. So as I said, my name is Anne Waters. I'm from the AUASB. So as Doug said, these are extraordinary times, and it's a rapidly changing environment. It's creating huge challenges for auditors. Quality financial reporting and audit is really important at this time, in this time of uncertainty. So the AUASB, we have issued what I would call unprecedented level of guidance in recognition of the extreme challenges that auditors are facing. So the objective of our guidance is to support auditors in fulfilling their responsibilities. Our guidance is based on our auditing standards, which are principles-based, but we're going into a lot more detail about how COVID-19 may impact entities and may impact the audit. We're also highlighting areas of focus which may result in heightened risk for auditors around areas where there may be possible risk of material misstatements. So we have issued some publications. We've also issued a series of FAQs. I'm not sure how many, but quite a few. I obviously can't go through them in a lot of detail today. However, please refer to our website. I will touch on the main points, but please refer to our website where the detailed guidance is. Okay, so I just wanted to give you an overview of, we've been working with the Accounting Standards Board and the regulators, so ASIC, APRA and ASX, and with the Financial Reporting Council and Treasury. This is all about making sure that there is a coordinated response to these extraordinary times, to make sure that all regulatory issues have been addressed, and to make sure that auditors and financial report preparers are given adequate guidance in all the required areas and that there's no gaps. We've been working with the International Standards Board and also other standard setters to make sure that there is consistency in the guidance that we're giving. We're also been conducting regular dialogue with auditors to make sure they're identifying all the issues and responding to their needs. That also includes working with the professional body. So it's been a coordinated response to ensure that we're addressing people's needs. So we've been working with the Accounting Standards Board. Obviously, it's important that the preparers are responding appropriately to the risk that their entities are facing, and also that that they're adequately disclosing the impact on the entity. So that's why we felt it's been really important that the AASB, the Accounting Standards Board and the Auditing Standards Board work together closely on this to ensure that preparers and auditors are being given appropriate guidance. The first publication that we issued was sort of fairly early on in the COVID pandemic, and it was really touching on what are the key financial reporting and auditing considerations that are arising because of COVID-19. That publication is sort of at the higher level, and it's really emphasising the importance of identifying the impact on the entity and considering what disclosures are required and how the auditor responds to that. Going concern is obviously one of the major areas that is impacted by COVID-19. For many entities, COVID-19 is creating events and conditions that are increasing the risk of going concern. Not all entities, but for many entities. And for many entities, they have to consider this for the first time. Going concern may not have been an issue in prior reporting periods, and now it is. So that's why we felt it was necessary to produce quite a big publication with the AASB. So it goes through what the directors and management's responsibilities are in relation to going concern and solvency assessment, and how they interact, and also their responsibility to assess whether the going concern basis of preparation is appropriate, whether there is a material uncertainty in relation to going concern, and how this impacts the preparation of and what's disclosed in the financial report. So this publication goes through in quite a lot of detail different scenarios and different disclosures that will be required depending on the risk of going concern for the entity. It also then goes through what the auditor's obligations are in relation to going concern, as well as solvency. So auditors have to assess whether the entities are going concern. That's a required auditing standard, and whether there's material uncertainty in relation to going concern. So this publication provides more details to how you would do that, what disclosures would be required, and what would be the impact on the auditor's report if they didn't agree with the disclosures, or if there is a material uncertainty in relation to going concern. It also goes through when the auditor may modify their opinion in relation to going concern. So that's we did that with the AASB in recognition of the importance of disclosures in relation to going concern, and also just recognising that for many entities they're dealing with these issues for the first time. Directors' solvency declaration. So Doug has mentioned this. The directors' solvency declarations form part of the financial report, and the auditor's report includes this. Nothing's changed. The auditor's report has always included the directors' solvency declarations. However, in the current environment, there is a heightened risk that entities will be trading whilst insolvent. So Doug touched on that there has been some temporary relief in relation to the insolvency laws, which may mean that some entities may be insolvent at reporting. However, they are still continuing to trade. That's new. That hasn't occurred in the past. Directors still need to complete their solvency declaration, and they need to make an assessment as to whether the entity is solvent at the time they make that declaration. Solvency declarations and going concern assessments are very linked, but they are different. So an entity may be insolvent at the time of the declaration. However, directors plan to trade through because they think that they are a going concern in the longer period, where a going concern period is more 12 months from the auditor's report. So directors are still required that if the entity is insolvent, they will provide a qualified or a negative director's declaration. That's always been a possibility. However, we're been very rare in practice, because in practice, if an entity is insolvent, they usually are being wound up. So auditors need to consider whether the solvency declaration by the directors is correct. So through their risk assessment and through their going concern procedures, the auditor considers if there are events or conditions that indicate that going concern is an elevated risk or that solvency is a risk. The level of work they then do depends on that risk. If they consider that there is a risk that the entity isn't a going concern, ASIA 570, which they've always had to comply with, has additional procedures the auditor needs to do. The auditor, if solvency, in relation to solvency, cash flows is very important. So solvency is about the timing of cash flows and whether debts can be paid as and when they fall due. ASIC have also recently updated their FAQs, which provide quite detailed guidance for directors on how to make their solvency declaration. So auditors will find that helpful as well. So when auditors are considering the director's solvency declaration, they consider whether they, with those charged with governance, have reasonable grounds on which to make that declaration. If not, they consider whether they have a Section 311 reporting responsibility. So the auditor, when they're forming their opinion on the financial report as a whole, consider whether they agree with the director's solvency declaration. Our FAQs go through that in quite a lot of detail about how you would do that and what might be the impact on the auditor's report if they don't agree with the solvency declaration. They would need to consider whether that is a material misstatement, and it probably is, so it really depends on the specific circumstances. If the directors issue a negative solvency declaration, they think that they consider what disclosures are in the financial report and whether and they're likely to have maybe a material uncertainty in their own report, or there may be an EOM. So it really depends on the specific circumstances of the entity. It is a complex area, so please refer to ASIC's FAQs, which provide background for directors on how to assess solvency declaration, how to perform solvency declarations, and it also has some guidance there for auditors, and our FAQs go through that as well. But that is an area that auditors are probably going to have to give a little bit more attention to than they have in the past, just because of the change in the insolvency rules, and that there may be entities insolvent at year end and continuing to trade. Okay, so auditors' reports. So we've issued some FAQs which go through the potential impact on the auditor's report. We definitely expect to see more reporting by auditors. So auditors have a number of ways to report in relation to COVID-19, and it really depends on the specific circumstances of the entity. For listed entities who are reporting CAMs, they need auditors think about whether the COVID-19 has resulted in changes to CAMs. So there may be items that were previously not CAMs which are now CAMs. So that could be something like a valuation of a certain asset. So there may be a change in the CAMs, or the auditor may describe how COVID-19 has impacted the way that they have audited particular CAMs. So we're expecting to see, and we are seeing through the CAM reporting, how auditors have responded to the risks that COVID-19 is creating for the entity and how that has impacted their auditor, how that has impacted their audit. We're also expecting to see some CAMs in relation to going concern. So if an entity, so CAMs are those items that the auditor has that were most significant to the audit. So if the auditor has spent a considerable amount of time in relation to going concern, however, there is no material uncertainty related to going concern, that may be a CAM. So they may decide that took considerable effort, it was a significant aspect of the audit, and so going concern was a CAM. However, if there is a material uncertainty, it is reported as a material uncertainty. So CAMs for going concern are only appropriate if it's a close call, so to speak, where there were indicators, however, there wasn't a material uncertainty. We expect there will be some more material uncertainties related to going concerns reported by auditors than in the past. The current environment, as we've just been through, is increasing the risk of going concern. So there may be more entities where the auditor concludes that there is a material uncertainty, and they'll refer to those disclosures in the financial report. Emphasis of matters. So an emphasis of matter, an auditor may elect to include an emphasis of matter in their auditor's report, and that's really if they consider that there are some disclosures which are fundamental to the user's understanding of the financial report. So emphasis of matters aren't very common, However, there may be some more emphasis of matters in the current period as auditors alert users to specific disclosures which they think are fundamental to the user's understanding. So remember that ASIS 706 cautions against widespread use of EONs, that they are really meant to be for disclosures which are considered fundamental to users' understanding. However, if auditors consider there are disclosures which are fundamental to users' understanding, they can bring their users' attention to those disclosures via an emphasis of matter. Modified opinion. So there may be more modified audit opinions in the current period. So there are three types of modified opinions. You have a qualified opinion, you can have a disclaimer, or you can have an adverse opinion. Excuse me, I've got a plug in my throat. So we do expect there may be more modified opinions. So a qualified opinion is when there may be a material uncertainty, a material misstatement, however, it isn't pervasive to the financial report. If there are misstatements or difficulties in obtaining audit evidence which are considered pervasive to the financial report, that's when a disclaimer or an adverse opinion is issued. Now, disclaimers and adverse opinions have been very rare in the past. Qualified opinions also very rare, but we may see more qualified opinions, in particular material misstatements in the financial report, which the auditor considers require a modified opinion. So we've also, as well as some FAQs to explain the different types of modified opinions and the different types of reporting that the auditor may do. So we've issued a series of FAQs to help with that. We've also issued a document which is called What Does the Audit Report Mean? And it explains the different aspects of the auditor's report and how auditors may use those to report on COVID-19 related matters. So please refer to that publication, it's on our website. We've also done a flow chart which may help as well, just to navigate as to what type of opinion to issue in what circumstances. Okay, so I've touched on probably the two main aspects that we've focused on, but so I said we've also issued other FAQs in quite detail about how COVID-19 may impact the audit. These are all based on the existing, our existing auditing standards. So audit planning and risk assessment, it's obviously very important that planning and risk assessment considers the impact of COVID-19 on the entity to make sure that the risks are properly identified in the current environment, which is different to previous audits. Also consider with FAQs that go through that there may be a heightened risk of fraud. If the entity is working remotely, etc., if internal controls have changed because of people working remotely, that may result in a higher risk of fraud. Auditors need to also think about what the changes in internal controls, how that impacts their audit approach. So the audit approach needs to be considered in taking into account COVID-19, the impact it's had on the entity externally through risks, but also internally what it's meant to their internal controls and their fraud risks. Audit evidence. So there may be some audit procedures which are more difficult to conduct. So auditors need to think about how they gather audit evidence. So they need to think about gathering audit evidence remotely. We have an FAQ on stock takes, so you may conduct that remotely. Auditing accounting estimates. So accounting estimates is obviously an area that's really impacted by this uncertainty. So our FAQs go through how auditors may gather evidence in this environment and the importance of disclosures in relation to the estimation uncertainty. ASA 540 has recently been reissued internationally, and we've issued it in Australia. It is more robust than the current 540, so I encourage auditors to look at that, as well as our FAQs if when they're auditing accounting estimates. Group audit considerations. So there's some practical issues for group auditors. So they need to think about how the risk of the group audit has changed as a result of COVID-19. And they also need to think about how they will get access to component auditors. So the FAQs touch on those. Subsequent events. So when we first issued these FAQs, COVID-19 was a subsequent event for December year end. But even now at June, in this sort of still evolving environment, auditors need to think about what's changed right up to the time that they sign that audit opinion. Professional skepticism. We have some FAQs that remind auditors about how their skepticism may be compromised through this period. So it's a matter of auditors being aware of how they need to exercise professional skepticism. So we have some specifically on professional skepticism, but our other FAQs very often touch on professional skepticism as well, because it really is fundamental to the audit procedures that we conduct. Interim reviews. So for some entities, they may be half year at 30 June, and so it'll be the first time that they've had to that they're reporting on the impact of COVID in their interim financial report. Auditors will be conducting reviews of those financial reports. So the IAASB, so the International Auditing Standards Board, have just issued quite a lengthy publication on how interim reviews may be impacted by COVID-19, and so we've posted that, as well as we've recently updated 2014 ourselves, so encouraging people to early adopt. The main change there is around the format of the review report. So auditors should think about whether they re-audit the review report for consistency with the annual report. So the main message coming through from the interim review publication is auditors are conducting a limited review, a limited assurance on if they're conducting a review of the financial report. However, if a matter comes to their attention, it also needs to do more. So in the current environment, I would expect that for an interim review, auditors will need to be doing more than maybe they've had to do in the past. So they need to make sure that they're properly assess how COVID-19 is impacting the entity when they're conducting their review procedures. But the publication, if you are doing an interim review, I really recommend that you read this, because it goes in quite a lot of detail how your review may be impacted by COVID-19. Okay, so what are the key challenges? I mean, Doug's already covered a lot of these, and I know Liz will as well. But it's definitely a challenging time for auditors. So auditors, think about challenging how you assess management and those charged with governance, key judgments and assumptions. So there will be some key judgments and assumptions that they have used when finalising estimates, going concern assessments, etc. Are they reasonable in the current environment? What evidence can they provide you in relation to what was the basis for those judgments and assumptions? As we've touched on, there's some logistical and practical issues due to the inability to access client premises, and a lot of audit firms are working remotely. So there are obviously some logistical and practical issues which are challenging. However, they can be, there are things that you can do. So please look at FAQs, and it really just takes, I think, some planning about how we're going to get the evidence that we need while we're working remotely. Remember, your client is likely to have changes to their controls and processes as a result of their own restrictions, planning alternate procedures if you can't perform certain planned procedures, such as if you can't go to stock take, what are some other procedures that you can perform, plan for that. The going concern solvency, it's obviously very, very challenging, but what does management base their assessments on, and is that reasonable in the current period? Accounting treatment, so there are a lot of very complex accounting treatments which are impacted by COVID-19. I've listed some there. It's probably not exhaustive, and Doug has touched on them as well. There is a lot of guidance about how these accounting treatments are impacted. So have a look at that and discuss with your client. Adequacy of disclosure in the financial report. So disclosure in the financial report, as Doug's been through, as mentioned as well, is really important. Have they disclosed the story on the impact of COVID-19? What has been the impact, and what are the key judgments and assumptions that management and those charged with governance have made when they are preparing the financial report? And are the disclosures adequate in relation to that? So it's a challenging time. However, we have attempted to provide guidance in all those areas to help auditors in these times. I now hand over to Liz.
Thanks, Anne, and hello to everyone. I'm going to spend the next 10 minutes just going through some of the practicalities of auditing during COVID-19, and whilst a number of these topics have been raised by both Doug and Anne, I'll sort of put my perspective on it in terms of some of the advice that I'm giving my clients, which are obviously a number of accounting firms and with audit practices within them. What I'm hearing is the new buzz phrase for 2020 is really around scenario planning. And what we really are talking about there is, whilst in the past we may have sort of looked at one assessment made by management or those charged with governance to support a going concern assumption, to support, a value and use calculation, I'd humbly suggest that in the current environment, one's going to need to think sort of more broadly in terms of, okay, what if this factor comes into play? What about if that factor comes into play? And I think certainly with the extended lockdown that is being experienced in Victoria at the moment, across the country, we can't ignore the fact that there may be further lockdowns, and what could that mean? So that's what we're really talking about when we look at this new buzz phrase called scenario planning. You really need to think through various aspects and ensure that the what ifs, and what, how comes are really brought into factor. And that's not just from management and those charged with governance. That's going to be incumbent upon you guys as well as auditors, particularly in the current environment, to ensure that you're thinking more broadly and with more depth in terms of how you're making your own assessments. So creating your own point estimates, etc., are going to be really important around this concept of scenario planning. In terms of approaching auditing for JobKeeper payments, for those that aren't aware, the AASB has issued a paper on how to account for government stimulus packages. From an audit perspective, though, I think, and there's certainly been some press around this already, I think what you're going to need to look at are a number of factors here, and the first one being what's the likely fraud risk in terms of, employees that don't exist that are receiving JobKeeper, instances where JobKeeper payments are being made based on reduced revenue, is revenue deferred, etc. Decrease in profitability, was that an appropriate basis? Now, the ATO has certainly come out, batting and saying, we're going to be really looking out for that. So I think this time around it's going to create some challenges for you guys in terms of what's the impact that potentially may have, obviously with the materiality overlay. The other aspect, obviously, is as JobKeeper payments currently on the government schedule are due to be finished by the end of September. Obviously, that may change as a result of the further lockdowns in Victoria. But you need to be mindful of what impact that potentially could have on the going concern assessments that both Anne and Doug have noted earlier in this discussion. If the companies aren't going to be held up by these JobKeeper payments, what's the likely impact to them as a result of that? We've also talked about auditors' opinions, both Doug and Anne, and I think from my perspective, I think we need to be careful that we're not diminishing the value of the auditor's opinion. And I know certainly in some discussion groups that I've been involved with, there was early discussion with some firms of saying, let's start at a disclaimer of opinion, i.e. we can't give an opinion and then work from there. And I don't think that's necessarily a very valuable place to start. I think every engagement is going to need to be assessed individually, as we always do, but obviously with an overview of the potential impacts of COVID-19. Not forgetting, of course, that there are many, many businesses out there also that have, flourished through this period as well. So those entities are normally in the essential services, food supply. Who would have thought that one of the most profitable entities during this whole process will be the producers of toilet paper. But there are certainly entities out there that will have flourished. So starting with a disclaimer as sort of a starting point is certainly not the right way to go. The other thing that Anne mentioned is the use of emphasis of matter, and certainly we saw an increase in the use of emphasis of matter subsequent to the sort of 20th of March when the pandemic was fully announced, because for reporters that hadn't finished their financial statements, certainly there was a number of disclosures in the subsequent events around the potential impacts to business around that where an emphasis of matter was used. I would say for those that were around at the year 2000, there was certainly a number of Y2K disclosures in financial statements, and nearly every audit firm had an emphasis of matter drawing attention. Arguably, that diminished the value of the emphasis of matter because everybody knew that the Y2K issue was there. So again, I as we come into this auditing season, I really challenge your use of the emphasis of matter paragraph if you so choose to use it. In terms of external valuations, I think certainly there's been some practical issues. If your clients, or even if you as an accountant in a firm are seeking to place reliance on external valuations, please note that they are as at a point in time. So if you obtain those valuations, March, April, May, by the time the auditors come to September and potentially October, those valuations may actually not be worth or you may not be able to seek the maximum reliance that you were planning to place on them. A couple of practical things that I've sort of done with my clients, and you may like to think about this yourself, in terms of assisting your staff on audit engagements, and that's creating what I've termed an aid memoir. So really going through the various aspects of the audit, sort of starting, with as simple things of cash at bank, and really going through and giving people out in your teams some additional points of focus for them in this environment. So, as I said, sort of breaking it down by section, and certainly use the FAQs that have been produced by the Auditing Standards Board, because they are very useful in you doing that. That's something you might like to think about. And what I'll do is I'll connect it with my final point here, and certainly something that sort of Doug started to allude to is we have a really big challenge this time, particularly if you're in Victoria, in in terms of auditing as a virtual audit team, you're going to need to put a lot of effort into trying to make sure that all audit team members know what each other is doing through the process. So I think the use of, platforms such as Zoom, conference calls, you're going to have to allocate a team responsibility in your engagement teams to, the practicalities of ensuring that everybody knows what each other's doing. And I think it's going to be really important that you're consulting with one another through this process. I think it's going to be critically important that you annoy your managers, annoy your partners or directors, whatever you call them in your firms, and ensure that you're engaging with them on a constant basis. So my last 3 words that I'll share with you before I hand it back to Claire, whilst my favourite term is consult in the best of times, my term now is consult, consult, consult. No question or conversation that you're going to have in the current environment, given we are in unprecedented times, there's no question that you've got that's going to be a stupid one. And to ensure that we maintain audit quality during this process, it's going to be really important that we consult, consult, consult. So I'll hand it back to you, Claire.
Thank you so much, Liz, as well as Doug and Anne. There were some fantastic insights there, and I would highlight that we will, when we circulate the recording of this, we will also send through the links to the ASIC FAQs, the guidance that Anne mentioned, as well as the AUSB FAQs that are very, very valuable. We will also be issuing a guide which we've have written in conjunction with the AICD and Chartered Accountants NZ, which we anticipate being published on Monday, which is a guide for directors, preparers and auditors on disclosures in the annual reports, particularly focusing on 30 June 2020 and how to address COVID-19 challenges for those groups. So that will be interesting for auditors as well, and it does highlight a number of these issues. So I recommend all of those resources to you. Now, we've had a couple of questions in the Q&A coming through. I've addressed one already in writing regarding the extensions of deadlines from ASIC, so I won't worry you with that one, Doug, but I would like to just pose one of those before we get stuck into some of the panel questions that I was keen to put to you. If I could just go back to one of the questions here from a participant. They're just checking in with you, Doug, if I could ask you to respond to this one on what are some examples of suspected contraventions that ASIC have seen in the past? And I mean, I note that in your slides you did highlight that, and obviously the auditor needs to report under Section 311 any suspected contraventions to ASIC or contraventions of the Corps Act. And you did mention in your slides that insolvent trading, if there was, if the auditor suspected that despite these insolvent trading relief for directors' liability, that was reportable, but that AGM delays in AGMs, if it's within the timeframes that ASIC have allowed, then that wouldn't be needed to be reported because there's no action on that. So if it's a no action matter, there's no need to report. I don't know if there's if you could give a bit more clarification about the kinds of contraventions you might expect auditors to report to you.
Okay, no, thanks for that, because it is a complex area and there are some judgments involved. That goes back to this specific provision. I should say there's actually 3 provisions in the Corporations Act about reporting contraventions. There's also 601HG and 990K for AFS licensees. 601HG is about managed investment schemes. But the thing about 311 is it is suspected contraventions of any provision of the Corporations Act. Now, that doesn't always mean the auditor needs to seek out contraventions in particular areas, but if they become aware of suspected contraventions, then they have the obligation to report them. But there are some conditions around that. And there are cases where matters are brought to the attention of the directors or reported in the director's report. That may be fine. There's also a significance test. And it was actually a significance test that we were using when we talked about the AGM, saying, well, we've given a no action situation. In this case, that means that we don't think it's a significant contravention. That won't always be the case with no action situations. By the way, it does depend upon the particular circumstance and provision. But the common ones we've seen in the past, and we do get a large number every month, and we look at all of them, are certainly around late lodgement of financial reports. In this case, by the way, when we gave extension of time, we've modified the Corporations Act, so the new deadlines apply, not the old ones, so there's no contravention. But other common ones are non-compliance with the accounting standards in the financial report itself. There's a range of ones we get around non-compliance with financial conditions of AFS licensees. There's a whole lot of other ones, but it pretty much can be any provision of the Corporations Act.
Thank you, Doug. So our participant mentions missed financial reporting deadlines. So you say that if it's within the additional month this year, then that doesn't need to be reported. But if it was in excess of that extended deadline, then it would need to be reported. And the other one was mentioned by the participant is late lodgement of tax returns, but that would be an ATO reportable matter rather than a matter report to ASIC.
That's right. It's not a contravention of the Corporations Act, it's a contravention of the tax legislation. I should have just add as well, we do have a Regulatory Guide 34, which gives a lot more guidance and some examples around reporting these sorts of matters.
Yes, great. So one other thing has been mentioned in our Q&A box, and that is the question is, what did we learn from Enron? Now, just to be interested in any of your thoughts on that. Certainly, my understanding with Enron is that that was a situation of the way the financial reporting was being presented was inflated, revenue and inflated asset values and so forth and so on. Obviously, we're moving into a difficult area now where valuations is going to be very challenging. So I don't know whether you want to comment on that question, Doug, in relation to any of the messages from Enron. I know the accounting standards have changed a lot since then as a result.
Yeah, it's a good one because we could probably spend an hour on this one, including the lessons for auditors. Enron and also WorldCom, of course, led to significant changes in Sarbanes-Oxley legislation around internal control sign-offs, audit oversight, and so forth. But one of the key things, and it was a factor of the US accounting standards as opposed to the international ones and the ones applied in Australia, that there does tend to be more rule-based requirements, and so they had some bright line tests which enable certain exposures to be left off balance sheet, for example. But yes, there were questions raised around skepticism of auditors, which can be quite relevant here, and so on. But yeah, we could probably spend an hour talking about Enron, and perhaps I'll leave it there for the moment.
Yeah, thank you so much, Doug. So now we will have questions for the other panelists. I don't want to leave you out, but I wanted to talk firstly, ask a few questions about disclosures. And you said, Doug, that there's a need for fulsome and transparent disclosures in financial reports regarding the impacts of COVID-19. Do you think, though, that directors and preparers may be concerned about disclosing too much about the uncertainties, and that may put them in a disadvantageous position in relation to their competitors? Particularly at 30 June, where you don't necessarily know what your competitors might be disclosing. And so how do they decide what's the right level of disclosure? And I guess what should auditors expect in terms of the right level of disclosure?
Yeah. Well, as a starting point, for most of the disclosure requirements, there's no question about information to competitors. There's no exception. It's certainly true for the operating and financial review. There's a limited exception where certain information could prejudice the company. But having said that, and have a look at our Regulatory Guide 247 on this question, generally speaking, the sort of information you might disclose is absolutely useless to competitors because they know much more and much more detail than you'd ever disclose. People worry about, pricing. Well, they've probably got your price list, by the way. You don't have to disclose your price list in the operating and financial review. So you really need to think about that one. And the other side of it is the importance of transparency. And when you think about that one, it's what you don't tell the market that's going to cause them more concern than what you tell them, because you're leaving them speculating. I thought this company would be affected by this, but they don't say anything about this. What's going on here? So it's all about confidence in the information. So you can actually end up with very negative effects and companies actually being downgraded. We've seen cases where even with non-IFRS financial measures, if they're not reconciled, analysts will say, not sure how that was calculated. We don't really trust those numbers. How can we trust the other numbers as well? So disclosure is so important. And I think it's worthwhile adding here, it's a good way to deal with questions around hindsight, but also liability more generally. But you need to have a reasonable basis for what you've done, but disclose what you've done. And then, by the way, if things change, particularly listed companies and other disclosing entities, disclose the change to the market, continuous disclosure obligation. So I just emphasise that, Liz said, consult, consult, consult. I've been saying disclose, disclose, disclose.
Yeah, great. And Liz, leading on from that, obviously entities have to make a whole lot of assumptions that you've all been speaking about today. Things like the progress of the pandemic, what the government's response is going to be ongoing, what restrictions will be in place. So do you think it's likely that auditors are going to need to ask clients for increased disclosure from what they may initially draft so that users are going to be able to better understand those assumptions?
I absolutely think so, Claire, and I think certainly my experience is that, there's going to be a number of challenges for auditors, particularly in the current environment. As Doug said, his 3 words are disclose, disclose, disclose. I couldn't agree more. And I think, obviously without impairing the independence requirements under APES 110, there's going to, I think, for less sophisticated companies, going to need to be some guidance from auditors and some support in terms of, suggesting to those charged with governance the level of disclosures that are actually going to need to be made in the current environment.
And I do have a question for you, unless you wanted to add to the disclosure issue. I wanted to move on to solvency statements. Yeah, you'll unmute yourself, Anne.
No. I mean, we're the same views that there should be a lot more disclosure in the current period, and that makes the auditor's life a little bit easier. And in terms of that, they won't be, booking statements in relation to disclosures. So, would agree with what everyone's about to say.
And so, Anne, I wanted to, as I said, move on to sort of insolvency statements and going concern, and the reasonableness of assumptions which an entity uses to assess whether they remain a going concern for the forthcoming 12 months is going to be really, really difficult for them and for the auditor to assess, because we really don't know. None of us know what's going to happen in the next 12 months in a lot of respects. So can you give us a steer on, what approach the auditor can take? I know you've spoken a bit about going concern already, but How is the auditor going to deal with this level of uncertainty?
Yeah, no, definitely it is challenging. But, I mean, you have to step back and I say to auditors, remember that management and those charged with governance have to make their own assessment. And they need to make a more detailed and robust assessment in the current period than maybe they've done in the past. If auditors don't think that they've got enough information, they need to go back to management and those charged with governance. So how have you made your assessment? On what basis have you made your assessment? And what are your plans? If you're maybe in business hibernation and things don't improve, what are your plans? And they need to have feasible plans that give them comfort that they've filled their responsibilities in making their own assessments that the entity is a going concern for the 12-month period. So, I mean, I just think auditors need to challenge management and those charged with governance about how they've made their assessment and whether they think that's reasonable.
Yeah, thanks, Anne. And Doug, I know you talked about assumptions needing to be reasonable and realistic. And so if those assumptions do turn out to be unrealistic, because it's so difficult to work out what's realistic at this point in time looking forward. So if in hindsight they're unrealistic, how do you think the auditor can satisfy ASIC about that, that they were reasonable at the time that the auditor assessed those assumptions?
Yeah, it's a good question. It may not be ASIC, it might be class actions or whatever. But the key thing is to document what the circumstances were at the time, why you made the assumptions that you did, and why you came to the conclusions that you did. That's the best way so that someone else is coming back can put themselves in or should be reminded of exactly where you were and why you made those judgments. It's actually a requirement in the auditing standards anyway, 230, to document the information another professional would need to not understand the work that's been done, but the judgments that have been reached. And it goes very much to that documentation. And then the second part, which we just touched on a moment ago, is if circumstances change, update the market as well.
Yeah, thanks, Doug. And look, back to you, Anne. I know you did talk quite a lot about the director's solvency, hopefully solvency statement, not insolvency statement, but it could be qualified, as you mentioned, and that's, been something we haven't seen before, especially now with some level of relief from insolvent trading in terms of directors' liabilities. Because it's something auditors won't have really come across, what do they need to say in their report if they see that?
So they need to consider. So if it is a negative solvency statement, the directors are saying that they are not solvent. So then the auditor needs to think about that in terms of the disclosures in the financial report and whether they are adequate. They need to think about what does that mean for the going concern basis of accounting, and whether they agree with the going concern basis of accounting. And then if the disclosures are adequate and they agree with the going concern basis of accounting, it could be that the audit opinion is unmodified. However, there's likely to be a material uncertainty they will report in their auditor's report or an EOM. So it really depends on the circumstances, but they do need to consider whether it's likely to be a myth, or whether if they don't agree with the basis of accounting, that would then be a modified opinion.
Thank you. So I do have some other questions around going concern, but I want to move on because I want to touch on some other areas before we run out of time. So asset valuations, I know, Liz, you mentioned that valuations may become rapidly out of date.
Yes.
So also there could be qualified valuation reports coming through. Valuers might have such a level of uncertainty around what they're looking at that they just have no choice but to qualify their report. So to what extent can auditors really rely on these valuations, and how much use are they going to be to them in assessing value of assets?
Yeah, I think it's going to be quite problematic this year, Claire, and certainly some of the practical advice that I've been giving some of my clients to give to their clients is around, if you've got an accounting policy that's driving the need for evaluation, say every 3 years, 5 years, whatever the accounting policy says, you may give some consideration in the current environment, given the uncertainty, to pushing back that valuation, because, you know, at the end of the day, we all know those external valuations are not cheap to come by. So that may be another practical thing. But I mean, there need to be a fairly sound basis for you know, making that kind of decision. And obviously it would need to be disclosed in the financial statements. But I think you're right. I think, you know, depending upon when the valuation occurs, and, you know, now we're looking at a number. In the past, you know, valuers would include a range in their reports. And certainly I know from the Valuations Institute, or whatever their governing body is, have been quite explicit about valuers putting quite hefty disclaimers in their reports in the current period, given the level of uncertainty.
I want to link into one of the questions from our audience, and I know you mentioned scenario analysis and how important that was going to be, and I think that relates to this issue of asset valuations as well. So the question is, how does COVID-19 and the increased use of scenarios impact materiality? Or maybe the other way around, I would say as well. How does materiality impact how we look at it? But I'll just finish the question. It's quite complex, I realise. And what extra onus is on users of financial accounts to allow for more uncertainty during these challenging times? So there's two parts. There's a materiality and scenario analysis, and also users understanding what they're looking at because of the uncertainty. I don't know if you can comment on that, Liz. Yeah,
I think in taking the materiality aspect first, I think, you know, generally speaking, it's certainly something that's seen as a reality in some of the reporting out of the UK, is that the levels of materiality are likely to decrease as a result of, and of course it depends on the benchmark that you're using, but materiality levels are likely to decrease in the current environment. So that's going to extend the level of audit focus, which is likely to be obviously on assets such as of what we're talking about. So I think materiality is certainly going to have a lot to play and increase the level of emphasis. The second point's a really interesting one. I'd be interested in Doug's perspective on this as well, is that I think, you know, there is going to have to be amongst all stakeholders and users of financial statements, and it comes very much back to Doug's disclose in terms of, you know, the uncertainties around, you know, asset valuations, etc. You know, and, you know, disclosures around the types of scenario planning and scenario, you know, forecasting that companies have done, to allow users of accounts to understand that, you know, whilst financial statements are at a point in time, we're in a you know, an environment of extreme uncertainty. So it's going to be, I think it's going to be really interesting to see how stakeholders react to the disclosures in financial statements, and certainly it'll be interesting to see how analysts also interpret some of the uncertainties that inevitably will be sitting within financial statements.
Yeah, and the materiality then, if it's smaller materiality, then those scenarios and the width of possible outcomes becomes harder to analyse. So I know we're now short of time, so there's so much to cover in this area. I want to actually talk about the overall impacts on the audit. So we've heard, and this is again for you, Liz, we've heard that there's going to be additional risk. We talked about remote working, a huge level of uncertainty. This sounds to me like a whole lot more work for auditors. So do you see audit fees increasing this year to cover this extra work, or do you think auditors are going to be pressured to cut fees due to, maybe, or their clients might well be struggling?
I think what I'm hearing from my clients and from their clients is obviously that, entities everywhere are looking to reduce costs where they can. And I know helpfully sitting within the ASIC FAQs, FAQ 20 is a statement from ASIC that companies are likely to see the need for a greater audit effort. So I think it's going to be certainly challenging from a practical and commercial viewpoint to actually get an increase in audit fees, even though the level of audit effort is likely to be greater.
Yeah. And I'm just going to put one final question because it's now 1:30 to Doug from the audience. So in the scenario where the entity, your client, has assessed that there's no material COVID impacts, so no particular disclosures needed on those impacts, do you believe there should be is no disclosure required, or is something need to be disclosed, even if there's no material impacts?
Yeah, it probably depends a little bit on the circumstances, but often it's material to disclose why there's no impact. Users actually understand that. So it have to be something really obvious, arguably not to disclose it, but then why not disclose it if it's so obvious? But yeah, look, I would, without knowing the specific circumstance they're looking at, I would have suggested it can actually be material to say why there's no impact. Further to that, we're actually saying if you're positively impacted, it can be very important to know that, and it's sort of that stockpiling scenario. Well, if people are stockpiling up to balance date, what happens after balance date to your sales when stockpiles reduce? So yeah, all of those things can be quite important.
Yeah, so good. So yeah, disclosing those key assumptions and why they've come up with no impact. But I guess this is where professional scepticism comes into play from the auditor's perspective to really bottom out that is the appropriate outcome of that analysis. So I'd like to thank you all very much indeed. We've now reached slightly over time. Apologies for that. But I'd like to thank Doug, Anne and Liz very much for spending your time with us today and sharing all those insights on the impact of COVID-19 on auditors and auditors reporting. It's certainly going to be a really challenging time now in the next few months for 30 June reporting season. There's a huge amount of resources that you've got on ASIC and AUASB websites, and we're certainly trying to reflect that in our communication with members. So we will send out those links with the recording of this session. So thanks again for joining us. If there's any outstanding questions left in the Q&A, we'll respond to those as well when we get back with the recording. So now, thank you all. I'd like to hand back to Siobhan.
Thank you, Claire, David, Anne and Liz, and thank you to everyone for your participation today. In the next 2 to 3 business days, you will receive an evaluation survey accompanied by a recording of this webinar. We really appreciate your feedback, as it is extremely valuable to CPA Australia to help us to deliver better events to you. Thanks again, and we look forward to welcoming you to another CPA Australia webinar soon.
Thank you all.